Okay, so let's turn our attention to private companies. Some companies, in fact, fund their own growth. The upside to this is you don't have to put up with any of the hassles that we talk about in this presentation. The downside is that their opportunities to grow are limited by their own checkbook. For some people, particularly the very small oil and gas operations, they're fine with that. They're simply trying to make money well to well. It is a pretty enviable position to be in, though, to not have to worry about raising outside funds because you have made enough money in the past that you can fund whatever it is you want to do. For the rest of the people, they often seek out a combination of debt and equity. Typically, this is called reserve-based lending or RBL. The common source for funds like this are banks. There are some energy-focused banks, but also many of the banks here, even locally, like Wells Fargo, Fidelity, they'll make energy loans. In fact, for some of you, that might be your entry into the E&P industry is that you use your financial acumen, enter into a bank, and then develop expertise as an energy lender. How does this process work? Well, it is all based off of what reserves does a company already have, which is to say this is not going to work for someone who has no reserves and they're trying to get their start. This is for companies who have wells and want to drill more wells and are willing to leverage those wells to fund the development of new wells. Typically twice annually, the banks will go in and do a determination of the borrowing base. This is based on the proved reserves and also what? Commodity prices. And so one of the things that caught a lot of smaller E&P companies that had these loans in the downturn of 2014, 2015, 2016 was their reserves weren't necessarily changing, but the value of the reserves were, I should say the quantity of the reserves weren't changing, but the value was because oil prices were falling so much. I'm going to pause the video right now so I can transition to a document I want to share with you. This is a document put out quarterly by a company called Macquarie, I guess is how you pronounce it. And what they do is they go out and they survey banks to see what their price deck looks like. And this is what their price deck looks like. Notice it's 2017 and then they look 5 years out into the future. And so this is what the mean is for all of the banks they surveyed, and I'll show you the banks that they surveyed at the end of the presentation. What that says is in early 2017, this composite of banks saw oil prices slowly rising over the next 5 years. It's also interesting down here, what they do is they put not only the mean, but also the high and the low. These suggest more conservative banks. In other words, they build themselves extra room, if you will, because they assume a lower price. These are particularly aggressive banks in that they're assuming a higher price. You can see that this bank is being very aggressive because the mean is much closer to the low than it is to their price. And those are important determinations. Here are the banks that participated in this. Notice many of these are Texas banks. Amegy Bank is a Texas bank. Bank of Oklahoma, obviously an Oklahoma bank, but in our area. West Texas, so First Capital Bank of Texas, Frost Bank, are all big Texas banks. Not surprising that they would be doing a lot of the energy lending. So part of it is determination of what price are we going to assume into the future, and that will also determine the borrowing base. Hang on while I switch back slides again. So as I put here, the pricing may be conservative, and then they will never loan you 100% of your proven reserves. Let's say you had $1 million in proven reserves. They're not going to loan you $1 million based on that. In the Macquarie survey, it captures different banks' proclivities, and it came up with an average of about 62% for the proved reserves. In other words, if you had proved reserves of worth $1 million, they might be willing to loan you up to $620,000. And obviously, this is something that the federal government and the bank regulators look at to make sure that banks aren't being overly aggressive. Typically, they loan you the money for 3 to 5 years. And sometimes it's interest-only payments with a balloon payment at the end. But it's to say it's not a 20 or 30-year loan. They're relatively life-limited loans. What can you expect in terms of covenants? Well, particularly for small E&P companies, a lot of banks are going to want a personal guarantee. In other words, they're going to not just want the assets of the reserves, they're going to want to tie up your personal assets. Obviously, the principals of these E&P companies hate to have to tie up their personal assets. And if they have a good track record, they won't agree to that, or they'll be able to resist banks' efforts to do that. But if somebody's starting out or doesn't have a good track record, it's very likely that's going to be a part of the deal. And so they're looking for some way to get their money back. They also tend to look at a interest coverage ratio, which is to say cash flow to debt ratio limits. A term that they use is EBITDA, which is something you're probably familiar with, earnings before interest, taxes, depreciation, and amortization. They add this little X, and that says they add back in depletion, exploration, abandonment costs, because they think that gives a better picture of cash reserves and cash flow for E&P companies. But basically, they're wanting to make sure that you're making enough cash flow to cover your debt. And then sometimes banks will include extra limits on what you're able to spend the money on. They may, for example, limit your draws on your credit line, or they may require approval to draw on the line of credit based on what the purpose for that draw is. So that's debt. What about equity? The most common form of equity that you hear associated in the oil and gas business these days is called private equity. Very simply, public equity is where you buy the stock in a publicly traded company. Private equity are private investments made in companies that are not publicly traded. They're very illiquid. I encourage you to click on this link to read a quick primer if you're not very up on what it means to be private equity. They're a major player in the oil and gas market, which I'm going to show you in a subsequent slide. So, who are the players? Well, the players are the people who raise the funds. Those will be the general partners. These are the people who are going to make the investments. And then they have a series of investors. Oftentimes, these are institutional investors, pension funds, for example. I don't know whether they do, but the Texas Teachers Retirement System may be investing in private equity, and often high net worth individuals. So the PE company or the general partners, they raise funds for a specific period of time, and that's key in how it affects the oil business. They then make investments in the various E&P companies, and then they expect to cash out. And I'm going to show you how EnCap approaches this problem, which EnCap is a very big private equity lender or investor we'll talk about. Well, how do these private equity guys make their money? Obviously, everything in this situation is negotiable, but a quote-unquote common way is that typically the general partners get a 2% management fee per year. Since a lot of the private equity funds run 5 to 7 years, that means that if they raise $1 billion fund, they're going to get paid $20 million a year in their fees. And then at the end, they get to keep 20% of the profits. So a 2 and 20 split is pretty typical. Private equity is a huge deal in the ongoing energy boom, in the shale boom. For example, in 2015, which was a bad year, and I say it was a bad year because this is right after the prices have fallen and everybody's trying to catch their breath. Capital expenditures, CapEx, is way down. There was still $39 billion of energy-focused private equity capital raised. That means that 1 year, funds were created worth $39 billion that were designed to be put into the energy industry. Now, a little less than half of that were targeted for the E&P industry. As we're going to look at it in a couple of days, the midstream industry is also very capital intensive and looks for a lot of investment. I've already mentioned EnCap, really cool. They're probably the leader in energy-related private equity, is based in Dallas. I actually had a chance to visit this company because a few of the companies, E&P companies of town, have done deals with them, and they were able to get me an entry. And one of their younger associates is a Wichita Falls native, and I've got him hooked up to probably whenever Dr. Forster in his energy finance class fits into his flow, we'll try to get him to come up and talk about EnCap and what private equity looks like from his perspective. So here's some staggering numbers for EnCap. They've been around since 1988. They've done 20 funds. Again, note the discrete nature of private equity. You raise a fund for a set period of time. $33 billion in those 20 funds. I heard a gentleman speak at a conference from EnCap. He said they've never had an unsuccessful fund. In other words, they've always met their promises to their investors. They've invested in 240 companies. Now, if you let me pause again, I'm going to call up some slides from EnCap to let you see their perspective of the world. These are the slides that EnCap used in an investor presentation I attended. And these just show some of their funds. You can see in 2015, they raised a $6.5 billion fund that was oriented towards more typical E&P investments, and they raised a $3 billion fund the year previous to invest in midstream activities. What they like to do is they like to find proven management teams who need capital and invest in them. In fact, when I met with the folks at EnCap, they said what they like to do is they like to peel off proven managers from established companies. And the reason they like to peel them off is because they know they're going to need money. And that's what EnCap is the business of, is lending money. So this is what EnCap does. They said, we bring in capital, strategic guidance, risk management. This is that proven management team they're looking for. They create a new company. They typically invest this sum of money. Notice it says maintains board control. EnCap is lead investor and maintains board control. This is, if you will, their covenant. They have a way to do this. Then they build the company, and then they sell the company. Notice here, they expect the company to last 3 to 5 years. And so this 5 years is a big deal. It means you have to get out. You have to have an exit. They're not looking to buy these wells and operate them for 10 or 15 years. They want to develop the properties, grow them, get some return, and then sell them to somebody else. Over here is the thing that may be pretty eye-popping. They are looking to get a 25% internal rate of return off of these wells. That means they're looking to make 25% interest a year on their investments. So now you can see why I say equity is typically much more expensive than is debt, particularly when private equity is involved. One last stoppage and we'll wrap it up. From a dollar perspective, clearly private equity is where it's at, but there are a lot of the smaller E&P companies that raise equity, but not what you would call through the typical PE firms. They simply approach high net worth individuals to invest in their wells or in their projects, and some of them even create funds in terms of limited partnerships and the like to raise money. Because you can see from the numbers we've been looking at in this class, nobody really wants to own all of something because it concentrates your risk. So a lot of people invest in other deals. Therefore, I think it's pretty easy to say that for all but the big integrated oil companies who have no problem raising money, or at least have good access to capital markets, it's a complex situation for the rest of the people, particularly for private companies. Usually is a combination of debt because it's cheaper and equity because it's more expensive and yet more flexible, are required to fund the heavy upfront capital investments. And so if nothing else, one of the things you should have learned in this class is that if you're very successful in your business career, that you might want to find ways to invest into E&P operations because they're always looking for money. Look forward to our class discussion.